Hello, it's Big Chuds, and this is the Trading Encyclopedia Daily Education series on my YouTube at Chuds Trading. Find me on Twitter at Big Chuds and Bitcoin Live, where I'm a founding analyst. For today's lesson, we're going to talk about a classical chart pattern called an ascending triangle. Here are some images of it, and here's a quick AI overview, and you can, of course, pause and read this on your own. It is a bullish continuation pattern, and I'll show you a couple examples here. Here's in an uptrend, and as well, here's different types of triangles. You may see a descending, here's a symmetrical, here's the ascending triangle. So here's an example. Now, normally a bullish continuation pattern, it can also, in theory, be some type of a reversal pattern where you have the higher lows with the flat peak. And the price is likely, and when it breaks out, you have a pretty good performing pattern there. But most of the time, it's going to be a bullish continuation pattern. And you have an initial move, and then it sets a range peak. And then it comes back, sets a low, peak, a higher low, peak, comes back, and attempts to break out. Now, the idea here is you have rising demand. You have the rising demand trend. You have the flat lows. Oftentimes, even in the order book, you'll see like an ask wall or fake sells here just to keep the price down while someone accumulates. The price is pushing higher, the price is pushing higher, and then it can break out. So the ascending triangle is a bullish continuation pattern. First, you need a trend to continue. You're not going to have it in a sideways. It can be after a reversal as well, but of course we're not going to act until we get a break of the overhead level of the horizontal structure. We have one here in Verizon, for example, on the daily chart. Now, what is your measured move? Well, you can take the measured move by taking the height of the triangle and extending it out from the breakout point, and that gives you a rough measured move. This is the same really with any triangle pattern. Rather than taking the length of the advance before the flagpole, you take the height of the triangle. Let's clean it up so you can see a better example. You take the height of the triangle and you extend it out from the breakout point to get your measured move. Now, normally you're going to see more volume in the beginning of the pattern, a little bit less as it trails off, kind of like this example here. So you get the most volume in the advance, a little bit less, a little bit less, a little bit less. And then when it breaks out, you'd like to see a trend break of that volume. So this is where you would trigger. Now, where's your stop loss? Well, you can use your higher lows. So that would be a stop loss in terms of when this trend invalidates. Stop loss in terms of when the pattern starts to break down. Maybe it turns into something else. But say you take a break here, your stop loss should be near the breakout point, ideally for me, because the idea is that it's breaking out, and that's why you're taking the trade. But this is an ascending triangle. You see the example here, ascending triangle. Here's an ascending triangle as well, as opposed to a descending or a symmetrical triangle. This is for the Trading Encyclopedia Daily Education series on my YouTube at Chuds Trading. Find me on Twitter at Big Chuds and Bitcoin Live, where I am a founding analyst. Folks, thank you so much, and I'll talk to you soon. Big Chuds out.